Eco. Anyway, I'm with National Center for Public Technology. We've been around since 1976. That's an amazing length of time for a nonprofit, believe me. And we have several offices around the country. We kind of actually have one now in Colorado, but that's a story in itself. But these are our principal offices around the country, and we work on sustainable agriculture. And ATTRA is a program that is actually a USDA Farm Bill program, funded, authorized in the Farm Bill, but we run it under a cooperative agreement and have for almost 30 years plus. And it is kind of the sustainable ag thing for USDA. It's a sustainable ag program, we call it. And again, this is ATTRA. This is our website. And it's a great website. We have probably, I can never keep up with the number, but 300 or 400 publications. We have videos, podcasts, all of that cool stuff now in the media world. You can follow us on Twitter, and I'm not one of those type of people, but we got all of that stuff. And really, I think it's a great resource. I think the only thing that's a problem with our resource is that it's really hard to keep everything updated. And again, the basis of this session actually is a 5-year organic OREI project, Organic Research Extension Initiative project. That was one of the most difficult of my life. And that's not a joke, actually. And it's a great publication if you really want to know. And it's good research, documented research and I wasn't the only one involved in it. There's some of the only surveys of crop insurance agents that I know of around organic farming. So check it out. It's long, and you don't have to read it all or anything, but it has some excellent chapters in it. And we've had now 2 peer-reviewed published articles based on this work. So it's a really good piece of work. So I'm going to give you some background. I'm going to talk about how to kind of assess insurable risk. I'm going to concentrate on insurance, and I'm going to try to give, of course, for this webinar, organic flavor to that. I always start out with this, crop insurance. I'm not here to sell you crop insurance. Sometimes people think that I am, but I'm not. And I actually, in my academic and other career, I never thought that my life would ever take me down this road of crop insurance. If you had asked me 30 years ago, would I ever build a career around crop insurance, I'd say you're crazy. And maybe I should have listened to myself. But it isn't the only way to alleviate risk. And in fact, as we'll see, most farmers in the United States, at least in number, don't use crop insurance, not because they might not want to, but it's just simply not available to them. As I say, the majority of farms and ranches in number do not have any form of subsidized insurance. So they get very good at minimizing and mitigating risk in other ways. And that's a very good way to do it. If you don't want your house to burn down, don't grow trees too close to it. This is a very jargonistic area. And these are some of the more simpler, and I have the tendency to just use the jargon because I've been doing it so long. So I try to give that. But the thing that we do want to point out is yield and revenue risk. They're very different. Most people think of crop insurance as something that some multiple peril that affects the yield of the crop or that destroys the crop, like grapefruits in Texas last year with the polar vortex. They destroyed a whole bunch of grapefruit trees, and that's a yield risk. That's actually a destruction of your capital risk. But anyway, it's yield risk. But most crop insurance, as we'll see, is revenue risk, which includes both the yield and price. And you think about it, there's actually another risk, and that's the one that's affecting a lot of farmers right now, and that's the cost of your inputs that can vary even within a season. And that's more like cost of production risk or input risk, and that's not often. There is actually a couple of crop insurance policies that deal with that, but we're not going to go there too much today. The Risk Management Agency is the USDA agency that runs the federal crop insurance program. It's actually the Federal Crop Insurance Corporation oversees that. We'll get to that a bit. This is important. Approved insurance providers, they tend to use the acronym AIP. And literally all the federally subsidized crop insurance, there are private policies too, but all of these 13 companies, there's only 13, are the truly only companies that basically service and sell the federally subsidized program. Liability, most people know this from their own health insurance, is the value of what is insured, and it's never 100% Gets pretty darn close in some cases, but it's never 100%. There's always a deductible, and there's indemnity, and that's the value of the payout for your loss. And then the premium, of course, is the cost. And as I said, the federal crop insurance program is a mixture of a public-private system. Some people even remarked that maybe it's the worst of both worlds, but at the same, this is the way it works. There's a federal crop insurance corporation. It's a federal corporation that essentially it dictates to the RMA some of the rules and makes some of the major policy decisions. And then you have private insurance companies. And these are these 13 AIPs I was talking about. And they basically service the policies, and the premiums run through the private, and then but it's highly subsidized by the federal government up to 64%. We'll see that later. And then they basically, but also when there's a kind of a sharing of the gains and the losses that also occur between the two systems. So many farmers think that, because they go to an agent, they're buying crop insurance, that they're buying a private product because they're buying it through a private company. And in a way they are, but they're really buying a program that is pretty much governed by the federal government in a relationship. A thing that most people don't know is that the crop insurance companies, those 13 companies, gain quite a bit from being part of this system. And here's actually a nice little chart that shows you. So every year, premiums are set, and then losses are incurred, and indemnity payments are paid out. But you never can predict exactly how a season will go. So sometimes you collect more in than you pay out, and sometimes the reverse. And this gives you a sense of that, because when you see the light blue, 2012 was probably in the last 10 years or so was one of the worst loss years for farmers across the country ever that use the federal crop. And you can see that actually it was a negative gain. So the dark blue is when there is extra, when they don't have to pay out so much, some of that money goes back to those companies. So they not only get money for servicing the products, they get what is called underwriting gains when in fact there is less loss than was expected. And you can see that, particularly from 2016 on, and I don't have the more recent information, but from 2016 on, you can see that, in fact, well, at least in 18 and almost in 19, or certainly in 2016, and back here even 2013, and certainly, there's more federal dollars going to the insurance companies than are actually going to farmers, which I don't think most people know. And so there is those companies are doing pretty well when it comes to running this program. This just gives you some overall sense of the magnitude of what's going on in terms of, so we have about $137 billion worth of value that is insured. And as I said, it doesn't insure all crops everywhere in the country because not all of them have insurance available, but that's quite a bit chunk of change. And about 10%, interesting, are collected in premiums, and this is in 2021. And you can see that some was paid out. So actually more was taken in than taken out in 2021. And that subsidization, I'm sorry, that isn't, but I made that mistake there. That is not, that's the subsidized premiums. Anyway, that's about 63%. In other words, of the actual cost of the insurance is subsidized by taxpayers, which is something your average citizen doesn't even know, I think. And then there were $5.3 billion in indemnities. So here you can see 13 in premiums and only 5.3 paid out. That this year was an underwriting gain. In other words, it wasn't a horrible year relative to the premiums. And so there's that net gain there. Fortunately or unfortunately, very few crops dominate the federal crop insurance program. You can see that corn, soybeans, cotton, wheat, and I just threw apples in there to give you a perspective, but corn, soybeans, wheat, 88 or 77% of the total covered crops for federal crop insurance are in fact only in those 1, 2, 3, 4 crops. And I think people don't really realize that. And you can see the relative level of subsidy. And yes, that was the average 63, but even some are slightly higher. The other thing is that there's no means testing for crop insurance, meaning that if you're extremely large, multi-thousand acre farm, in proportion, you would get as equal amount of benefits from the crop insurance as a small little 300-acre farm somewhere in the United States. And in fact, it's quite skewed that the benefits go to and this is what this is. It's a bit dated work. It's a friend of mine that did some of this work, Eric Belasco, I've worked with over the years. But you can see in the yellow, the subsidy per acre and the proportion of subsidies received. So the top 10% crop sale farms are getting most of the subsidies. And then as you get smaller, there's they're not the ones that are really getting. And so if you think about it like in taxation, there's no really progressivity in this in terms of, that perhaps the larger, more well-off farms could pay more of the full cost, as larger, bigger income folks pay more of the taxes. We don't have that in crop insurance. There always appears to be a lot of different kinds of policies, and there are, and they're quite confusing because they all have little anomalies. But really, there isn't. It isn't fully. There's just not availability. So if you look at corn. These are the counties where you can get crop insurance and revenue insurance. Remember, revenue is both yield and price risk. And all of these counties, you can grow corn. Now, this wasn't always that true. I live in Montana, and I often want to say, and I can't prove this, but there's a lot more corn grown in Montana than you would think. And personally, I think probably more than maybe is smart, or it's very somewhat risky, although corn has been adapted to a lot of different climates. But because you have really good insurance, it also kind of, in a sense, makes it possible or easier to take the risk to grow corn in places where maybe corn ought not to be grown, but that's what it is. And then you can see that if you change the product, this is just fresh market tomatoes, and it's really hard to see where those green counties are. So if you want fresh market, and that's only yield protection, that's not revenue protection like corn, you have a few counties in California. You would notice even in Ohio, there are none. So you can't get a fresh market yield protection in Ohio. And you've got only these few counties and states. And of course, Florida is a big tomato producer, so of course has them there. In a way, this is kind of where large commercial operations of fresh market tomatoes occur. But it also shows you that if you're in Montana and you want a fresh market yield protection, good luck, you can't get it. And in a lot of places. So another thing is specialty crops, and this is just, it's a lot of reading, but essentially what is there is that special crops are not like your commodity crops. And if you just look at the data, there were in 2017, this is the last ag census, there were 242,000 plus specialty crop farms. They had $87 billion worth of value, over 15 million acres. But in terms of the liability coverage, because there were not many policies available for them, that only represents about 2.1 billion. So in other words, there's really about $87.7 billion worth of value, but only 2.8 billion of it is could be covered by insurance. So there's a lot of farms, in other words, of different types and a number that have no access to either yield, revenue, or any kind of federally subsidized crop insurance policies. However, the one that I'm going to spend the most time with today is whole farm revenue protection, because it's something I've been working on for a long time. And I think it could be a helpful solution to solve a lot of problems around crop insurance. And it's it's actually really the only revenue protection for a whole farm across, and it's available in every county in the United States. So I indeed can get coverage for fresh market tomatoes in Montana, where I live, under a whole farm and I get revenue protection in Montana, but I can't do it for only fresh market. I can only do it for the whole farm. Okay, that's the first part. Are there any questions at this point? Hello, is everybody hearing me? I hope they've been hearing me.
Feel free to unmute if you'd like to unmute and ask a question. If
Or in
you'd
the chat.
rather type it in the chat, you can do that too.
And we can move on. It's just thought make some breaks here so folks can, before I talk too much, which I do too much. Any questions?
I'm just assuming you're next going to talk about this whole farm revenue, because that seems
I sure am.
All right.
Yeah, we're gonna have maybe too much. You'll get bored, but no, you'll get confused. Hopefully not. But yes, I'm going to come back to whole farm revenue and some new things that have actually been happening to it quite recently. In fact, even this week. Anyone else? Okay, let's go. So I'm going to shift a little bit to Ohio here for you guys, since we're in Ohio, and I should have had this in better order. Somehow I didn't get soybeans ahead. I wanted to have it in terms of the largest. Like the United States, Ohio is very similar. Corn, soybeans, even wheat, which surprised me a little bit, are basically dominating the federal crop insurance program in Ohio. Interestingly, I thought, because I hadn't looked at Ohio specifically that much, there's some nursery that's called a dollar policy. It's a little bit like basically a dollar value. You basically protect some of the dollar value as estimated of the nursery. It's a kind of interesting way of insurance. It's not exactly, it's kind of like revenue protection. This pasture range forage is a rainfall index. I'm doing more work on this lately, and it's being used across the country. It's being used mostly in the Southwest, but it's actually related to rainfall, and it's based on literally on satellite data. And it's interesting to me that seeing that Ohio farmers are using it. I know you grow popcorn, and you have both. This RP and yield policy means they're both revenue and yield policies. This is an index insurance, which I said is different. We won't talk about that too much unless somebody asks. But you see, there's your revenue and yield protection for popcorn. But then when you get to a lot of specialty croppers, there's only yield protection. And of course, whole farm is a revenue, meaning it protects both yield damages and market changes in prices. And I threw it in apples there too, because apples. But you see, really, the big people using crop insurance in Ohio are for corn and soybeans. And if you mix even all of these all together, and these are all the other ones, so you have sorghum, grapes, hybrid corn seed, which is very specialized, potatoes, barley. And so these are really all the only types of policies that were sold in 2021. And I'm sure you grew more than those things in Ohio. Now I'm going to take you to something, and I hope this is going to work, but we're going to go off this to an internet site. Is everyone seeing this? Amelie, give me a cue, because I sometimes get paranoid.
Yep, I see it.
All right. This is a really cool tool that was created by the climate hubs. And the climate hubs are regional entities, offices. They're really combined across several USDA agencies. And they created this cool tool based on crop insurance. And I'm going to load this viewer. Hopefully it's going to load. And I'm going to go. So you get this map of the United States, and these are all the counties, some 3,000, I used to know the number of counties, 3,301 counties in the United States. By the way, Alaska and Hawaii are in there. They don't always fit in the screen, but actually I can shift over there. It's a really cool intermap. You can actually move it around. So yeah, I could move it over to Alaska. Alaska does get crop insurance, believe it or not. And what we're looking at right now are all the counties of the United States, and I'll shift it. You can go in the county framework. The unit of analysis in crop insurance is the county, because even in one county, like here in Montana, you could have some policies that are different by county and that are available in one county and not the other, for instance. But if I shift to the state view of it, then it gets a little kind of more easier to see. And this is just really the payment indemnities from 1989. So this is the total amount of indemnity payouts on crop insurance over that long period of time. And you can see, and this gives you a kind of perspective. Now remember, crop insurance is dominated by a few crops. So obviously we're not representing all crops in this map, but you can see that like if the darker it is, that means there were more payouts. So one way of kind of thinking of this, why I think it's useful, is that they're like North Dakota, Iowa, these darker states, even California get darker. This is like somewhere between 10, I always want to say that's 10 billion, right? Yeah, 10 billion and 20 billion over that period of time in payouts. So in a way, these would be considered the riskier states to grow things, particularly commodity crops, but also because they are only covering a lot of them. That it is so it's a little bit, but it gives you some sense of where risk is greater. And Ohio is not too bad. What is really cool about this, if I shift, and I'm going to use this county for later on, if I go to, and I can like do the typical thing, and I can shift over here and bring Ohio, because I'm trying to focus on Ohio. And I had this, if you go deep enough, it'll actually give you the county names. I'm going to be doing some of my examples based on, I'm doing oh, thank you. Sorry, I've got somebody in the room here. And I'm going to do it on Allen County, Ohio is the one I'm going to use. So that's Allen. But you can see, you can actually get down to so if I pick Allen County, it will give me the information about Allen County. So over this period of time, $63 million in indemnity payments have been made from 1989 to 2020. Does that make sense? And you can actually go to this little thing here, and it will give you some extra information that I think is useful about Allen County. So this tells me when the indemnity payments were made in what years. You can see that some years, and you can see it's very volatile. You can see that corn, soybeans, and wheat, as we knew already, dominate the payments in Allen County, Ohio. You can see this is kind of how they were paid out over time, which I find it particularly useful. This is probably the most useful thing if you live in Allen County. You can see that the cause of loss was excess moisture, precipitation, and rain was one of the major causes. Drought over these years. And this can kind of give you a sense of climate. It can give you a sense of what are going to be the causes of loss. You can see also decline in price as a cause of loss, $4 million some dollars, which means essentially for revenue protection, means that price was a greater risk, was a significant risk in Allen County, Ohio. Cold was somewhat too, but mostly this excess moisture. This area plan is kind of they need to fix this a little bit. That's a certain kind of insurance, and it really doesn't relate to a cause of loss. It's really about county-wide losses, but unfortunately, they didn't distinguish that very well. Anyway, I'm going to try to go back to my other thing, but I just put this out here because you can really go down to you can look at your county in Ohio, and you can kind of see where things and the causes of loss and what happened. And it's a good way to do a kind of an assessment of the risk based on history. It will also give you some perspective on where we're headed, perhaps in terms of climate. And we're doing some work on that later. So I'm going to get out of this. I'm hoping, can you see my thing again or not? Am I back again?
You're back.
All right, it worked. I'm always so paranoid when I do that. And here I'm going to give you some, now we're going to get into whole farm revenue. Oops, I went too fast. This gives you overall national, we did some research, that report I was talking about. So I had some relatively detailed, but this gives you some sense of the participation rate, the level of liability, the level of value of whole farm. Whole farm is not a huge policy, but again, it's an interesting one, and you can see how it's changed over time. And it's been declining in use, which is kind of distressful for me. Before 2014, this is actually a program called AGR and AGR Lite, which was really very similar to what became whole farm revenue. That's just a little perspective on the history of it. Here's its use in Ohio. And some of this information, it's a lot of information, I realize that. But you can see that whole farm revenue was created technically in the 2014 Farm Bill. So it was first available in 2015, and not many people knew about it in Ohio, or around the country for that matter. There are only 4 policies. Then it did have an uptick, and people were interested in it. And then it started to decline, and now it's declining even worse. And this is causing quite a bit of distress for me, since I spent most of my professional career trying to promote this kind of insurance, which I'll show you why later. But in Ohio, it's declining in use significantly. 2021 is tentative because it takes a while for the data to catch up. So that might actually be higher, or at least hopefully closer to 11, which isn't many policies. This actually gives you a sense of the, and I have this more specific data again from the research. You can't get this data as easily, but the different crops, even though it covers the whole farm and the whole farm revenue, and isn't really about crops per se, these are the crops that have been used on their whole farm. What I found interesting is that what was not suspected is that soybeans, corn, that people are even insuring soybeans and corn and hay and other things with a whole farm revenue policy. I don't know why hay is in there twice. I think there's two different kinds of forages, and popcorn, and some of the classic ones that you would think people would have an individual policy on actually have insured under whole farm revenue. I found that somewhat interesting. So here's the gist. I think the biggest thing to think about whole farm revenue, what makes it unique, and why I'm talking so much about it today, is that it ensures the estimate of the expected economic capacity of the farm to produce a gross, not net revenue, up to a maximum. And the maximum is down here. And so if you think about it, it's a basic way to think about it. Instead of insuring any crop you're growing, it's not an individual crop policy. It's not an individual revenue. It's not an individual yield policy. It's really saying your farm, let's say, can generate 200,000, on average has generated $200,000 a year. We'll pay up to 85% at a cost that's subsidized, just like all insurance. You could cover it for 85% of that historic revenue. And if you have a loss below that, we'll compensate you. So it's basically protecting revenue, not protecting crops. So it says to the farmer or rancher, it says, grow what you want to grow. And based on your capacity to grow it, we will insure some value of it. So the choice, this is the critical point, the choice of what you want to grow is left to the farmer and not influenced by the insurance. So much of what is issue about crop insurance is that if we have, like we do, really good corn insurance, there's a tendency to keep growing corn because you have good insurance, rather than necessarily corn being a sustainable or an economic thing, because that insurance, again, pushes you that way. Whereas whole farm revenue has nothing to say about that. It just says, what's your revenue? We'll protect some of it. Unfortunately, you have to have at least 3 years if you're a beginning or veteran, and 5 years if you're not. And the way your revenue guarantee is decided, this economic capacity is measured, is through tax records, which is not what it causes a little bit of an issue, but you got to figure that out somehow. And it covers really almost any product, livestock and crop, because it isn't about the livestock or the crop. It's about the revenue that those livestock and crops produce historically, which is the basis of your coverage. So you can actually, it covers up to $10 million, which is not a lot of farms that are grossing over 10 million, but there are some. And so it isn't for the biggest farms. And it does have some limits on livestock. If you just had a pure livestock farm, you couldn't get its maximum coverage, but it's something that's changing sometimes. There are people thinking about changing that. It's not just for small farms. We have a 13,000 acre grain farm in Montana using whole farm revenue, and it's because they're organic, and they don't have any options for organic coverage of some of those grains, and because they grow a lot of different things for which there's no coverage, and some of them are very valuable. So whole farm revenue can work for big farms, it can work for small farms. RMA tends to tell people that it's only for small, diverse farms, which is really not true. And in fact, the reality is, if you look at the history, it isn't just small farms using it. Indemnity payments won't be made until taxes are filed in the insurance year. This does cause a problem. In other words, you can't really get your payment for your losses until you file your taxes because that's the basis of determining your loss. And it's the only crop insurance that incentivizes, and not extensively, as we'll see, diversity. So the more diverse your farm is, the more different products you grow, both livestock and products and or crops, the lower the cost. And that just makes logical sense. If you don't put all your eggs in one basket, you have less risk. It automatically embeds, to the extent you've been an organic farm and your historic revenue is represented by organic values, it's built in. That's your revenue history. That's your organic sales. That's your organic value. So it's there. That's not true, or not easily true of other individual organic policies. It only covers the value of the raw product. This is a little bit of a problem. So in other words, if your revenue is generated because you're making strawberry jam out of those strawberries, you have to go backwards and take the value of the jam out, and it can only cover the raw strawberries, which gets complicated if you're value added producing. But your agent should be able to help you with this. The premium subject coverage improves with 3 or more products. You can't only get up to 75% coverage if you have 3 or less. If you have 3 or more, it goes up to 85%. So, for more products, you could get better coverage. Again, unfortunately, it tracks historic expenses, and if historic average expenses do meet the 70% threshold, you can have your premium or your indemnity payment. That should really be indemnity payment reduced. I just found in a sense, not spending the amount of money on your crop can be. This is the only crop insurance policy that does this, and we have been asking RMA to remove this requirement for about the last 6 or 7 years, and they don't. And they don't give us a good reason as to why they continue to do this, because no other crop insurance has some kind of penalty for not spending. Like if I grow corn and have a revenue corn policy, they don't say, well, how much did you spend on that corn? And if I didn't spend enough, they're going to penalize and take away my indemnity payment. And there's a new micro program, which I'll get to, and I'm not really psyched about it, but I'll explain it. This gives you a sense of what I was talking about, the only policy that incentivizes diversity, which is becoming an important thing for climate. And in fact, the USDA has remarked, it's the only crop insurance that they remarked in their recent climate plan. They said whole farm revenue is a good policy because it incentivizes diversity. And we know diversity will build climate resilience. And so it's a great product. Unfortunately, there's only like 2,000 policies sold, so it's not having that much an impact. But here you can see, what I did is ran scenarios. Again, this is in Ohio. So we just say we started with a farm that had fresh cat, processing tomatoes, and popcorn. That's 3 commodities. And the premium would be $9,000 for that. And I'm assuming a revenue guarantee of $340,000 and an expected value of $400,000 from each one of these. So each one of these I adjusted so there was never more than $400,000 in value and an approved revenue. So this thing stays the same. But as I add another crop and the same value being covered, you can see it initially, it went up a little bit when I added oats, which has to do with the relative riskiness of those crops. And apparently growing oats in Ohio is risky because that's why it went up, which you would expect it to go down as you add diversity. But then it continues to go down. And as I add additional crops and crops and crops. So when I move from 3 to 9 products, I get a 16% reduction in my premium cost. Hence, the incentivization of diversity, which is one of the very, very attributes of whole farm that is something that I'm very excited about. And here is a farm, just a single farm with 80%, with the kind of corn, soybean, wheat thing. And so this is the T yield. We'll talk about the T yield is the county average organic yield, which is totally kind of a made up number because they don't actually have the data to do this. So what they do is they use conventional prices, conventional yields, which are the county conventional yield, and then they basically factor in it lower to some degree. So this is what they think the yield in Allen County should have been in 2021. And I bet some organic corn growers are getting better yields than that. But anyway, and so you can see what the premium costs are for that value. Again, this is that 400,000 thing. So this gives you a little more detail on the cost and what we cover. We're going to have another example of that too. So, but some things matter. Whole farm costs can depend on the variability of your historical approved revenue. Now, this will become more clear to you. If you have a highly variable revenue, it means that your capacity or the average, let's just say, and there's different ways they calculate the average, is likely to be lower because of that variability. And therefore, in the year of insurance, let's say you're getting better, you might actually expect to have a higher revenue, but your history says, no, you're pretty variable. So the greater degree of your variability, the likelihood that the policy may not cover what you expect. So it depends on how different your expected revenue in insurance years compared to your history, and depending on that variability. Depends on how many products you produce. Again, more lowers the premium generally. Depends on the relative expected value of what you produce. You, in other words, could lose one crop entirely in your whole farm, but if the other ones generate revenue, then your whole farm revenue doesn't, and you don't get paid out. But that's good. You don't want your house to burn down so you can collect the insurance. You don't want your farm to be wrecked so you collect the insurance. You don't. I think sometimes people have this idea that if insurance doesn't pay out, that's a bad thing. In a sense, that's a good thing because it means your revenue was protected. And almost always it's less expensive than individual crop policies, which I don't think. So in other words, you can actually do corn, soybeans, and wheat, and covering them under whole farm revenue in most cases that I've run will be cheaper than buying individual policies for them. There's this thing called combined direct marketing in the micro program. And in 2020, so it's very recent this has occurred, any of your products that are direct marketed to consumers can be combined together into one lump thing. Now remember, only those that are direct marketed. So if you are selling to restaurants or you're selling wholesale and you're selling at the farmer's market, you can only do this direct marketing option if you're with the part of your revenue that's generated by that farmer's market or that direct to consumer. And it must be at least 2 products that are direct marketed. In other words, you can't just sell squash at the market and cover that under the direct marketing part. And so you don't have to list them separately. So it saves on paperwork a little bit if you can combine those things together. However, it cannot be more than 2. And really what that means is that even though you have many crops in that direct marketing, they're really treated as if they were 2. And so if you were only direct marketing, you would only have 75% coverage, which you don't get that advantage of that higher level of coverage. And it does require still providing sales records to determine these values for those direct marketed products. Here's an example of a fruit veggie farm. And so this is a fairly large gross revenue, but you can see the volatility of the revenue, significant, maybe realistic, maybe not. The reason I'm doing this is because there are like 4 different ways to determine the premium for this farm. You have your straight average, which is 798,000. You could take also and replace any lowest in your history by 60%. So you take 60% of that, and that's 479,000. However, there is no, as you see from the original, there's no year in which it was 479,000 or lower. So then I can't stick in that 60%. So these averages are the same. There's another option where you could throw out in your history the lowest year, and that does bring up your revenue history capacity up a bit, which is important because this then becomes the value upon which you reserve. And you can also do this 90% option if you had previously had whole farm revenue. You could also choose to just do 90% of your previous determined and approved revenue. And that would have been 801,000. And generally speaking, and as you will see, the farmer, you have to run all of these scenarios, and you will usually change the one that's the highest, because usually in your expected year of production, you're higher than your historic average. So you want your historic to be as close to your expected as possible, because the revenue guarantee is on your historic, not on your expected. So here we go. We got, this is not, so this one is using the combined market. 2 acres of that, that's 150. So that's a lot of different crops. Then they're growing strawberries, and that's pretty valuable, tomatoes, pumpkins, and this combined directly. That's essentially 4 commodities, and you can see the expected revenue. So this is what we're starting with. And so I should go back. And so that's one option. If it was only direct market, you could have 10 acres and they could have that, but then you would only get 75% coverage of that historic revenue. So we have this historic revenue. So the revenue guarantee is based on the lower of these 2, which is that one. And then at the trigger point, i.e., you have to have, in the year that you're insured, you have to have a loss, if you're covering at 85%, that's lower than $707,000 before you would see a dime. In other words, you have to have that much of a wreck, either revenue-based or yield-based. The loss required before payment is, so in other words, with this farm, in this scenario, the direct market or the combination, you would actually have to have a $124,000 loss before you would actually see a payment. So if the total premium is this, and the producer premium is that, then, I'm sorry, this is the total premium is that, the producer for this coverage would have to pay $52,000, so there's a subsidy of almost $67,000. If it was all direct.
Jeff, I'm sorry,
Sure.
This is Emily. I was just giving you a heads up that we've got about 15 minutes left.
I'm going too slow, so I'm going to go faster. Anyway, you're going to see these, and you can run through these scenarios, but it's just giving you a sense of how it works. And if I had this mixed direct, this is basically, where I would end up at the end after insurance, and this is where I would end up. And you can go through these more carefully later. It's more important that I get. Here are some of the downfalls. It can be very onerous, especially if you have a lot of products, to essentially even get into the policy. The crop insurance company, it has the power via its agents to ask for even more records than your tax records if they have reasons. And so you should ask them, because you really should only have to provide them your tax records, but they have, unfortunately, this power. And this micro program is coming, but it's only for farms that gross revenue is less than 100,000, or if you had whole farm 120. So only for a very small subset of, and this is an addendum policy that's part of it. Okay, questions. Now I probably have questions, and I don't have that much more to go, so we can still get to the end. Or I can move forward and we can do the questions at the end, unless there's some burning ones.
Jeff,
I know
I just had a really quick question.
Sure.
Would the expense penalty punish growers transitioning to organic who may have lower expenses?
Yes. I mean, it would be based, here's how it would be based on what your historic expenses were, based on your tax rep, again, also with your Schedule Fs. So whether you're organic or not organic, it's going to be those 5 previous years or those 3 previous years. If you do not meet in the year of your insurance 70% of what was your historic expected expenses, you will be penalized. You will get less of an indemnity payment or a payout.
Well, that's just another disincentive for transition
Yes, it is
to organic.
It absolutely is, and it's a disincentive in general. And there's, as far as I can tell, and I've been doing this many years, and I've asked many times, I have never been given a good reason as to why they have put that into the policy. And we have asked them to take it out. It causes extra paperwork. It is a disincentive. It makes no sense. No other crop insurance policy has anything like it. And they just look at us like we're crazy for asking, but they don't do anything about it.
And I don't want to take up any more time, but with the rising cost of inputs, people are probably looking. And really, even if they had higher input costs for 3 years and then input costs go down, right?
Exactly. And I think, I mean, I can make this up. They have not ever told me this, but my reasoning is something like this. They're fearful for some reason that whole farm revenue, because it's based on tax records, that people are going to be perpetrating fraud more likely. And they don't give us any evidence, and it's not likely that's true, but they think if they follow your expenses, then somehow, you're not like deliberately trying to cause a failure by not spending money on your farming. But that's true of any farming. So that doesn't even make sense, but I think that's the logic they're using.
Thank you, Jeff. Are there any other questions? We've got a little more than 10 minutes left.
Okay.
Go
ahead.
I have a question about the micro program. Yes. Just if you go back a slide there, the history of the farm needs to have that income. Oh.
Right here?
Yeah, so.
Yes, so in other words, what that means, that if you're going to use the micro program and your gross revenue history average, let's say that approved revenue was greater than 100,000, you're just not even eligible for this program.
And so it's the average of all, because like we've steadily been growing our farm, yes. But we were like, what if we downsized?
So what would be, would it, yeah. If you downsized, it wouldn't matter because it would be based on your historic revenue, not on your current revenue.
So sorry, it's the average of all of our years.
It could be, remember I went through 3 different scenarios. It's a bit confusing. You can do 3 different types of averages. You can have the straight average, replace with 60%, take out your lowest year, and you can, or 90%. Anyway, there's a game. But whatever that approved revenue is, and your agent can come up with, if it's more than $100,000, you're not eligible for this program. And this is the biggest criticism we've had of this program. While there are many farms that obviously exist that perhaps have less than 100,000 gross revenue on average historically, they're not that many farms, and probably ones that don't want crop insurance anyway, unfortunately. So they've created a program, in my opinion, that isn't going to serve many farmers and probably won't serve even the farmers they think they want to serve. Does that make sense?
Yeah, and I agree with that.
And it's too bad.
Not a very high number at all.
And we called them out on it and have been calling them out on it. And they just, again, they thought they were helping the smaller farmer by doing this. And in a way, they may have helped some smaller farmers, but honestly, just from my experience, I don't think it's going to work. And unfortunately, it's supposed to be less paperwork, but I've been looking at it more closely, and you still have to have a level of documentation that's not so much required by most other insurance policies. So, here you go. You have a smaller group that are very diverse anyway, who probably don't want insurance and probably do not want to deal with paperwork. My prediction is that not many people are going to use this, and I'm probably going to get in trouble for saying that, but that's my assessment of it. They thought they were doing something good, and there's a long history as to why they thought they were, but we don't maybe have the time to go into it. Oops. Any other questions? Did I answer yours? I'm sorry, I didn't mean to.
Yeah.
Okay, I'm sorry it wasn't a better outcome. I wish they had listened to us when we made recommendations on how to improve whole farm, but instead they went this direction thinking they were doing something good when in fact I don't think they were. I mean, if it's the road to hell is paved with good intentions, isn't that what they say? I'm in trouble for saying that too, I suppose. Okay, I'll finish up here because I just really have a couple more points, and then we can dive into any other questions if there's some time left. This is something I've been working on a long time. RMA has a very peculiar definition of what a good farming practice, and this really affects organic farmers because organic farmers are some of the most innovative farming practices to resolve issues, to make their farms resilient than any other group of farmers I know. And I've worked with organic farmers almost my entire professional career. And this is a stickler. It says, so it's not actually a list of things that are good farming practice. It didn't say well, they are saying that cover cropping is a good farming practice now. It really is not about a list of it. It's about a definition. And it says any production method utilized to produce the insured crop. That's fine. And you can see all the other provisos, but look at that red thing. But it has to allow it to make normal progress towards maturity and produce at least the yield used to determine the production guarantee or for a yield policy for even for a revenue policy of the insurance. Meaning that if I adopt a new practice like cover cropping, and somehow that will affect the history of my yield or revenue, and it will, either up or down, then in fact, if it doesn't at least produce what it historically produced, it by definition is not a good farming practice. I'm going to give you another slide really quick here. This is actually verbatim from the handbook. So this is not, I didn't make these words up. The use of NRC conservations will generally be recognized in your area as good farming practice, provided the adoption of such a practice does not negatively impact the insured crop's ability to make normal progress toward maturity. There you go. Toward at least you determine the protection of the In other words, if you adopted cover crops, well, let's go to the next slide. So is covering cropping a good farming practice? Depends if it affects your yield when you adopt them. Can I interseed and be a good farming? No, you can't. You can't. And you know, if you tried to intercede and you actually informed your agent, you would lose, and you did it, and you tried to get a claim, you would lose significant amount of your payment. You would basically not be covered by interceding, because it's not a good farming practice. Because of course, if you intercede, it'll affect your historic yield. It'll affect your, you know, it will have that effect. Is organic farming a good farming practice? So all the sustainable farmings are good farming only if they do not impact that yield. And they even have different definitions for organic and sustainable, which I find kind of kooky. There's also, this is brand new, and you can read about it more. This also now includes whole farm revenue. It has to do with that if you can get extra premium support, in other words, your premium can be reduced by $5 an acre if you use cover crops. So interestingly, however, this does not even change that good farming practice definition. So you still could possibly be in trouble, in my opinion, even though they're paying $5 extra in lower cost insurance for using cover crops. This just came out this week, so there's some details on that. We can't have time. This is another thing that came up, and Emily knows this case, but basically it is that if you're transitioning, tell your crop insurance agent you're doing so. It really does, probably will help you to do so rather than not to do so. However, I believe RMA has still not figured out properly how to deal with transitioning organic farmers, in that they really are not, they're just using T yields that are kind of made up. They establish these actual production histories, and you want to really start getting your actual production history, because that's the basis of your insurance, to be replicated by actual organic practice. So my recommendation would be, as if you're making transitioning acres, please inform your agent you're doing so, because you want to establish that organic production history that will really help you in the long run. And there's closing dates. So for this year, generally speaking, that's February 28th for Ohio. This will give you a great way to find an agent local, and really look for an agent that has worked with organic farmers if you're organic, who has worked with whole farm revenue, who's open to selling it rather than somebody who might not be. Always make sure that you look at all the options, and if your agent's not willing to go through the options, I wouldn't even like that agent. The agent should be willing to look at all options available, including whole farm. They legally must run these options for you if they are federal crop insurance agents, which, you know, if you're going to them, they largely are. If you have contracted prices that could help, and again, explore those options fully. And I'm just going to end with climate disruption. This is just showing you the extreme precipitation events. And even though it looks like a fairly flat, it's rising very rapidly. Crop insurance is going to have to cost more. It's going to be more important, unfortunately, in the future. And hopefully we're going to move to the kind of insurance that will be more effective in dealing with this disruption. And there's a little their website is very good. Check it out. And again, here's some links that you can have for later. And I'm done. Thank you.
Thanks so
Any
much.
more questions?
Yeah, thank you, Jeff. We have time for some questions, and we can even go a few minutes over. Do folks have specific questions for Jeff?
Don't be shy. if you want. I mean, I think that I wish I could have presented a more, in a sense, hopeful. I think crop insurance works fairly well, and it's certainly worth it. It's a double-edged sword, though. In some ways, building a farm that's resilient and it can deal with risk is also a good thing to do. As I started out, you shouldn't depend on crop insurance. In other words, think of it like health insurance. You know, health insurance is important to have, as we know, particularly with high costs of insurance. But living a healthy life is also a good thing to do, and it will limit it. Similar with farms, you know, you can sustainable organic practices, because of the diversity, in my opinion, are moving in the direction of resilient systems, and therefore the cost of their insurance should be reducing, and will in some ways reducing. And I think whole farm revenue is a particularly good option for the future in climate, because really we shouldn't be telling farmers how to farm and what to grow and what to produce. We should simply, to me, the main point of the insurance is like when your house burned down, you want to be able to get a new house. When you have a serious illness, you want to recover and move forward with your life. When your farm has a big tragedy, you want to be not made perfectly whole, but to be able to continue. And that really has to do with the revenue. It really shouldn't depend on whether you grew grapefruits or you didn't grow grapefruits, or you didn't grow corn or you did grow corn. It should really be more about that protection to continue farming. And that's why I think whole farm revenue is going to be a better option for the future.
So Jeff, just a couple of kind of observations. First,
Yes.
I want to thank Rowan for putting the evaluation link in the chat. Please fill that out. I think, you know, understandably, RMA is focused on fraud concerns, but
yes,
we know fraud is still happening regardless of with their, you know, buffers that they have in there, because I think the amount of farmers who are kind of don't ask, don't tell, doing what they need to do or trying to improve their practices. And given what you've shown us and what many of us know to be true about increase in weather extremes, if we're trying to move farmers to more sustainable practices, just that good farming practice definition of moving to a new practice that affects yield or revenue, you know, over what period of time? Does that mean in 1 year? Does it mean over 3 years?
It means for an individual crop, it means 10 years, because your actual production history is based on a rolling 10-year average.
Okay,
and so,
but you know,
it's actually a little more complicated than that, but basically it's a rolling 10-year average of your history. And for a whole farm, it's the 5-year history. That again is always the previous 5 years. So for a whole farm, it's the history that's 5 years. For individual crop policies, it has to do with the yield of those products over a 10-year rolling average.
So we know that as farmers move to some of these practices, they often experience a reduction in yield, but not always, right? And if we're trying to promote resiliency, you know, it just feels at cross purposes. It
is. And I think that it continues that way, and they continue to hold on to that definition because it makes life easier for them to set premiums, which is a hard thing to do. I grant them that it's a hard thing to do. And so what they like to do is that if people change what they do, if they're innovative, that screws up their ability to determine risk, and they don't like that. So it's really more out of a self-interest in terms of setting accurate premiums that they're doing that than they are thinking about the consequences. They simply just have to strike that wording in the definition. And really, I think if we would say that anyone that has an organic, certified an organic system plan, or is using a practice that is okayed by NRCS, I mean, that will move us. That should just simply ipso facto be a good farming practice, period. And it has nothing to do.
You know, and I'd love to see what changes you were proposing, because just what Emily brought up. I mean, if the new micro farm policy is not going to help a lot of farmers like Emily and Ben out there, and they aren't seeing what they need out of whole farm revenue, they're still being left out.
Yes, it's a shame. And there's an interesting history as to how that occurred. And I watched it and was part of it. I mean, I tried really hard. They did I'll give you a quick history. They hired, for a lot of money, a contractor to go around and have listening sessions. I think you were part of those. I was part of those. And with that information, this is what they came up with the micro program. And I was on many of those listening sections trying to say, don't do that. I said, do this, don't do that. With the micro policy, I didn't make that. You don't have to deal with the expense thing in the micro policy. That just went away. That was our recommendation. I mean, that was the National Sustainable Ag Coalition for many years, to get rid of the expense requirements of whole farm revenue. And they did it for the micro program, but only for this tiny segment of agriculture. When we were arguing, do it for the whole program, not just for the micro program. And as to your issue of fraud, there's actually good research, and I can provide it for folks, that shows that the way they're dealing with fraud in federal crop insurance across all crops, not just whole farm, and they have never provided any evidence to suggest that whole farm revenue is any more fraudulent, and it's likely not to be if you think about it. It's based on your tax records. If you in fact perpetuated fraud under whole farm revenue, you could possibly have both tax and insurance fraud case against you. Who's going to take that risk to get a little better deal with their crop insurance, or get some kind of, I don't think many people are. I mean, yes, in all insurance, everywhere, not just crop insurance, there is fraud, and it is an issue, and you have to be aware of it. And they actually RMA has a good program. They do spot checking, and I've seen research that suggests that it is not as bad, but there is I always feel like they feel it is, because when you look at it, they're actually doing a pretty good job with fraud. That doesn't mean we have to be blind to it. It just means that we shouldn't wreck the quality of the program because you're so worried about fraud.
Right, right. Well, this is such an important topic, and it's really kind of formative to the kind of agriculture we see on the ground and what our choices are. And so, Jeff, we really appreciate the work that you have done and continue to do, so that, as you mentioned early on, so that, you know, crop insurance is not determining what people grow. You know, the people can grow what they want to grow, not based on,
or honestly, how they grow.
Right. Exactly.
That's even important too.
Right.
Why should RMA, an agency that deals with actuarial science, be telling farmers how to grow? They have no idea how to do that.
Mm-hmm.
And really, they don't. And they're doing it only because they're trying to predict premiums better. And that's not a sufficient reason and it doesn't serve the sustainability and the progress of agriculture.
Well, thank you.